A public service announcement before I begin. Over the last couple of months, every now and then, there is a scumbag that keeps showing up in the comments section. And he's using my logo. So when you look at his comment beside it, you see this. Making it appear that it is me leaving the comment, and in the comment he's saying, I got something for you, here's my WhatsApp number, give me a call on WhatsApp. It's a crypto scam, that's all it is. It's just some scumbag that has no particular skill in life, and this person's best idea is to steal from other people. I will never ever leave a comment under your comment that asks you to contact me somewhere. If I want you to contact me, I will leave you my email, direct email that you can email me directly, or I'll say something in a video, something like that. But I'll never, ever, ever leave a comment to contact me somewhere, and I will never, ever ask you to invest in some kind of crypto program or try to sell you on a crypto idea or anything like that. So that's what this person is doing. I watch the comments pretty much live because I have my iPad with me, and YouTube Studio gives me notification of every comment that comes up. So when I see these things, there's a lot of comments too, directing you to porn sites, directing you to download illegal movie. A whole bunch of this kind of stuff goes on. I try to clean up the comments section as much as possible by blocking them. Blocking them is the best because they have to keep coming up with new names and new accounts every time they want to get something done. So it slows them down. But when I see it, I try to block it. But this person here doesn't leave a general comment. This person replies to other people's comment. Good comment. Thank you for contributing. Yeah, reach out to me on this on WhatsApp. I got something for you. Yeah, that kind of thing. So if you've run across this, or if this has happened to you, or if it does happen to you, it's just some little scumbag with no particular skill in life other than to steal from other people. I think the key word we need here is pity. And this is for their parents. We have to pity their poor parents, because what do the parents say when somebody says, oh, by the way, how is so-and-so doing? How is your child doing? They must lie. Oh, they were killed in an earthquake last year. I mean, they can't tell the truth. Oh, he's running a crypto scam on WhatsApp. He's really good with technology. I mean, they must lie. They must lie. Their child must be a source of embarrassment. Poor fellow. All right, let's jump right in here. Last week we had a rally on what seems to me a rather thin reason, but we'll take it anyways. And it was based on Michigan consumer sentiment, particularly the inflation expectations came in at 5.3 as opposed to 5.4. This is survey based. It's not an objective measuring stick. It's survey based. To me, 5.4 and 5.3, based on asking people what they think, to me that seems like the same number. But the market was looking for almost any reason at all. There was so much negativity that you felt, well, we were almost due for a rally. Give us any kind of reason for a rally. And bear market rallies tend to be really sharp because you got not only buying, but short covering at the same time. I think this is something that could be sold into. It just doesn't feel like it has the basis to form an opinion that, okay, we've put in the bottom and up we go from here. I don't know that we've put in the bottom until we get through earnings and see what earnings look like, until we get past the next Fed meeting, until we see another few inflation reads and really do see them come down. Then I can start to say, well, I think we put a bottom in. Next Friday is PCE, which is the Fed's favored measure of inflation. So that's going to be a big one. We don't have another Fed meeting till July 27th. It's a little too early right now to be handicapping 50 or 75 basis points because you do have an inflation measure sitting in front of us. And we have some more economic data. And along with earnings, before the 27th. My best guess is somewhere between 65 and 100 companies would have reported earnings by then. We'll have a good idea of what margins look like. That's going to be looked at a lot. We'll have some idea of the effect that the strong dollar has had on margins, or at least net income margins, and on earnings per share. And we'll see whether or not companies are beating expectations both on the top line and bottom line. Is revenue strong or EPS strong? These are nominal measurements. Earnings are always nominal. So they're not real, they're nominal. So being that inflation is where it is, it wouldn't be there if prices that companies were charging weren't there to begin with, which means it should be reflected in revenues and EPS. We'll see what we get. Keep in mind when we trade stocks, when we look at the level of the index, we're looking at a nominal amount, not a real amount. Let's look at our rates. Not much to talk about here, and I don't know that there's going to be much to talk about until we get until it becomes the story of the day again as we get closer to the Fed. Money market rates pretty much increased across the board except for the 1 year. Capital market rates decreased across the board. And we put in a new high on the 2-month and on the 6-month on Friday, 1.6 and 2.51. Slope still kind of flat-ish, not quite flat, not inverted, but flat-ish, down, 85 at the beginning of the year. We're sitting at 9. Slope increased week over week, but decreased from the 3-month to the 5-year, 3-month to the 10-year, which if you're looking at bank profitability, this is a better measure of bank profitability, is the spread between the 3-month, particularly the 3-month and the 10-year for mortgages, 3-month, 5-year for industrial loans, corporate loans. If we look at the Fed funds futures, the implied Fed funds rate, December 2022, the index is at 96.685, implying a Fed funds rate of 3.315, which is somewhere between 3.25 and 3.4. 3.15 to 3.4. April 23, it peaks 96.47, which gives us a Fed funds rate of 3.525. When I say it peaks, the implied rate peaks, and then it drops from there into December 2023 down to 3.175. So I'm not sure if this is the market thinking that inflation will come under control and the Fed can relax and bring rates back, or the Fed will have pushed the market from a mild slowdown into a serious slowdown into a contraction, which is a recession, and that sometime after April rates are going to have to drop back because the Fed would have gone too far. Then the Fed's going to have to start worrying about unemployment and the health of the economy at that point. Real yields, all of them pulled back. And the lower real yields go, the better it is for valuations in terms of discounted cash flow for present value of any kind of future cash flow. Break-even rates kind of mixed across the board, but 2 basis points, 2, up 2, down 2, 0 across here. I'd say that's a big unchanged. The 5-year forward went from 2.36 down to 2.3, easing a little bit there. Still don't think there's much to see in rates right now. 3-4 months ago, it was the best story in town. Right now, it's like, well, okay, yeah, the rates are where they are. They're not making any really big moves. Volatility is kind of dying down on the rates a little bit. They're there. It's an issue, but I don't know so much that it's the leading issue right now. Let's look at 30-year fixed mortgage, 5.85 for the week ending June 24th, down from 6.03 last week. The adjustable rate mortgages, if we're concerned about a housing crash that might look like 2006, there's a number of reasons, or sorry, not 2006, 2007, 2008, there's a number of reasons why that's not going to be the case. That period was massive overbuilding. and a lot of selling to individuals with credit ratings that should never have gotten these loans to begin with. A lot of teaser rate mortgages that were going to reset higher in a year. So you can get in really cheap now, and then they were going to reset a lot higher. So if we're looking at adjustable rate mortgages, there are 2.5 million of them right now. There were 13 million of them in 2007. So that's significantly lower. If we're looking for how many resets are going to happen this year, 1.4 million. In 2007, 10 million were going to reset. So you don't have this kind of big hit coming. Yeah, it's there. You have 2.5 million that are adjustable rate, with 1.4 of those set to reset. I'm going to reset higher, but that's nowhere near that 10 million. Not only that, there is a shortage, a low level of inventory on both existing or used, no one really calls them used houses, but existing homes and new homes. There's low inventory on that. Less than 3 months on existing homes, 7.7 on new homes. Sounds like a lot of inventory, but only because the annual run rate is so low. It wouldn't take much inventory to suddenly say, "Hey, we have 7 months of inventory." We'll see that. We'll see that shortly. Existing home sales down 3.4% for the month of May. That's negative 8.6% year over year, based on May 21 of last year. So it's down 3.4% from April, and this May is down 8.6% from last May. The median home price was 407.6. When we say the median home price, that is a transaction-based price, because these are home sales that have happened. Mortgage applications. This is where it gets a little curious. Up 4.2%. That's the second week in a row that mortgage applications are up. Refinancing index is down 3.1%, and the purchase index is up 7.9%. New home sales were up 10.7% in May, but were down 5.9% year over year versus last May. The median selling price was $449. The average selling price $511.4. The median has got more information in there. New home sales up 10.7. The previous month, we had seen new home sales down 16.6%. Well, that was revised to only being down 12%. So, I look at this. The existing home sales are down 3.4%. New home sales are up 10.7%. Perhaps there is an anchoring effect going on with existing home sales, because anecdotally, well, you know what I mean. I have trouble with that word. I've said that before. I tried saying that word before, and for some reason, it sticks in my mouth. I can't get it out. Anecdotally. There we go. Talking to a couple real estate agents, and they both said the same thing, or along the same lines, as people want to list their houses, but they're listing them at prices that were around 6 months ago, and that market's gone. But they don't want to hear it. No, let's just start there. Let's just start there, see what happens, and if it doesn't sell, we'll lower the price, because they've got it in their head that they're going to get 1.4 million for their house, and you have to try to tell them, look, it's that market is gone. That was a frothy market that's gone. You're not going to get that. You're not going to get that number. So perhaps existing home sales are down 4 months in a row, because you have sellers who have this idea in their head about a number, and they are anchored to that number, and they don't want to adjust from it. No, I need that number. That's the number it's worth. That's what it was worth 3 months ago. I want that number today. Whereas for new home sales, these are builders. They're not attached to it like an existing homeowner would be. When they look at it with a lot more cold rationality. You need to clear inventory. You need to move houses. We need to lower our financing costs. Let's just get it gone. So we'll look at, we'll break these down, both of these down a little bit more. Realtor.com. This is unchanged now for 3 weeks. Median listing. This is the listing price, up 16.9% year over year. It has not budged. That's why I seem to think there is some anchoring effect going on here. when it's first listed, it's listed at a price that, well, look, you're not going to get that. It eventually drops. Redfin has some good data on this showing how many houses that were listed had price drops. New listings are up 6%. Year to date, flat year to date. It was negative for a while. Now it's year over year, being up 6% at this point is the same as last year, being up 6%. Active listings up 21%. We can see the progression over the last 4 weeks. It was up 13%. The week after it was up 17%, then 21%. And selling 4 days faster. That is unchanged as well, which means even though it's on the market, it's still selling quite fast. And Redfin has some good data about the percentage of homes that are selling within 10 days of listing, selling within the first month of listing. Something like 80%, 88% of homes are selling in the first 30 days of listing. That's a slowing market. So it's going to have to slow a lot more. Okay, a lot going on here. What have we got? Let's have a look at this first chart. This is housing inventory, active listing count in the U.S. And this is from mid-2016 all the way up to May 2022. 516,362. The last report for existing home sales price year over year was up 14.8%. And since they are sales, it's transaction based, not listing based. Average time on the market 16 days in May. That does not sound like a market that is in the doldrums. First time buyers, 27% of sales were to first time buyers. That's down 4% year over year. So first time buyers are slowly exiting the market. All cash buyers made up 25% of sales. All cash buyers tend to be investors, people who are buying properties, multiple properties, large companies that might own hundreds of homes that continually buy, or people who are buying their second home, typically are cash buyers. So 25% of all the sales were cash buyers. The low point for active listings here in the U.S., 376,000, February 2022. What I did over here was I looked at existing home sales, January, February, March, April, May. Look what happened here, 6.49, 5.93, 5.75, 5.6, 5.41, straight down. All of them just going straight down. And then I calculated the number of months of inventory based on the number of homes that did sell for the month, how much inventory we would have. Seasonally adjusted, of course. These are not seasonally adjusted. You have to use a seasonally adjusted number for listings. These are raw numbers. So if you use the seasonally adjusted numbers, January you had about a month and a half of inventory based on the run rate of 6.49 million. By the time you get to May, based on a run rate of 5.4 million houses per year, you've got a little over 2.5 months of inventory. So from January to May, you added more inventory. But you also dropped the amount of houses being sold. So it looks like you have 2.5 months of inventory at this lower run rate. But whether or not you have more inventory, if you adjust it for the higher run rate, well, you'd have to do the math there. For new home sales, January through May, 831 to 790 to 715 to 629, and then a jump to 696. Whereas these were all going straight down, these were going down, then they went up. These are new home sales. So it could be that builders are just, pricing it to clear the inventory at this point. Just to say, let's pare down our lines of credit. Let's pare down the financing that we're using. Our financing costs are going up. Why hold on to the property? Let's just clear it. And based on the inventory, again, seasonally adjusted, you have 7.7 months of inventory. To take a closer look at new homes here, the last report showed price for new homes were up 15% year over year. Sales, making up new home sales here. Houses that weren't even started made up 30% of sales. They hadn't even been started yet. Sales, ones that were under construction, 44.5% 4% of sales were for homes that were still under construction, and only 25.6% were for completed homes. This chart over here is housing units under construction. And from mid 2016 to just before the pandemic, this series grew at 3.6% per year. And then after the pandemic, it grew at 18.8% per year. And if you listen to the home builders, they'll be very clear with what's going on here. Materials, can't get housings finished, and labor, can't find the people to work on them. In fact, about 3 or 4 weeks ago, I introduced one home builder that was saying, look, we're delivering houses without windows. We're just putting boarded up windows, and when we get the windows, we'll come back and install them. But they're delivering homes without all the parts to them, without all the materials included. Lennar reported earnings last week, and they said we are seeing demand dropping. They did fairly well. Revenue, they reported 1.3 billion versus their comp. Their comparable was 831 million. This is year over year. EPS 449 versus 265 year over year. And home builders, the home builders ETF, I think was up 7 or 8% last week alone. The lack of materials, the tight labor market, and the low level of supply mean that getting a slowdown in the housing market to affect inflation expectations or to affect actual reads of inflation, I think the sort of base case that you could look at as being plausible is flatlining on pricing, is no increasing in pricing, but I don't expect to see a lot of decreasing in pricing. Not that it's not going to happen in certain frothy markets, but nationally on average, which is what inflation is going to measure. It's not going to measure it in, just this city or that city, but nationally. I don't know that can happen given the low level of current inventory that already exists. And given the high level of all cash buyers that exist in the market now, you're competing against that. So, yeah, the housing market is going to see a slowdown. There's no doubt about that. The builders are already seeing a slowdown. I think builders are already pricing their properties to move them as quickly as they can. But I don't know that we're going to see 20-30% price pullbacks. I think those prices are gone. I think in the really frothy markets, you could look for maybe up to 10% price pullbacks, maybe 15%. But the market is not in crash territory at all, given the credit quality of the borrowers in the market, given the credit score of those that are holding mortgages right now, significantly higher than 2006. The number of adjustable rate mortgages significantly lower, the number of mortgages set to reset significantly lower, the level of inventory in the market significantly lower than in 2006. And mortgage rates significantly lower, even though they're elevated right now, significantly lower than in 2006, 2007. Keep in mind the Fed funds rate in 2007 was 5.25%. We're sitting at 1.75%. Fed funds futures is saying we'll top out somewhere around about 3.5% in April of 23. 3.5 versus 5.25. So I wouldn't look to the housing market to suddenly drive itself off a cliff. I think it'll slow, and that'll be it. It'll slow, and who knows where it goes from there. But we'll just have to watch the economy unfold. The inventory simply doesn't exist, and the susceptibility of the mortgage holder to higher rates is not the same as it was in 2006 by both a credit standard level and by both and it's not by both, but and by the amount of mortgages that are set to reset. We're going to stick with mortgages and mortgage debt just a little bit more, but we're going to layer on top of that more debt, and then we're going to look at a really great report. It's from the New York Fed. The link is in the description box below. You depending on what you want to look at, you'll probably find a whole bunch of interesting stuff, but we'll look at a few of the charts here. This is household debt to GDP. Sitting at 80% household debt to GDP. Look at 2008. Look how much higher it was back then. That made it even worse because interest rates were a lot higher. You had a credit crisis with a country that had a lot of household debt. We don't have a credit crisis right now. We have much lower interest expense than we had in 2008, and you have a balance sheet that looks a lot better, 80% debt to GDP. That's total debt. That's everything, including the mortgage plus other debt. We'll see how much of this the mortgage makes up. This is household debt service payment as a percentage of disposable income. Look where it is. Yes, it has gone up in the last 6 months. But let's draw a line across there just to put things in perspective. Look at that. Lower than, from 2010 to 2019, from 2000 to 2010, from 1990 to 2000, it's lower as a percent of disposable income, which means, households in the 80s, households in the 90s, households in the noughts, households in the teens were paying a much higher percentage of the disposable income to service their debt. Now, it's going to continue to go up, I'm sure, because rates are going to continue to go up. But it would really have to go up just to rival this period that we had back here, or even to rival the late 90s, which was a period of exuberance in the stock market. So much has been said about, all of the debt that we have. But it's, when you put it in perspective over a long period of time, sure, if we're going to look at something for a 6-month period, that looks terrible, but put it in context. It's not as if the consumer's never seen this before. They have seen it. This is the quarterly report on household debt and credit, Q1 of 2022, released by the Federal Reserve Bank of New York. We're not going to go through the whole thing. I'm going to show you some interesting charts. There's some narration, which is a summary narration right at the very beginning. And then you get into a whole bunch of really great charts to look at. We're going to look at the first one, total debt balance and its composition. Then we'll get into the mortgage originations by credit score and the auto loan origination by credit score. Then we'll jump down to selected charts by age, and we'll look at the total debt balance by age and the debt share by product type and age. And something here I looked at, I go, well, that's interesting. I wouldn't have expected that. And when I say that's interesting, not interesting in the sense that it's anything tradable, just I look at it and it's kind of like, well, that's odd. I never would have expected that, but there it is. So we'll have a look at that. Let's look at our first chart, total debt balance and its composition. The orange line at the bottom, that's mortgages. And for 2022 Q1, 71% of household debt balance is mortgages. 2% come from home equity and revolving lines of credit, 9% from auto loans, 5% from credit cards, 10% from student loans, and 3% from others. And this gives you an idea of the size of the debt. This is in trillions of dollars. But when we're looking at, should we worry about debt, it's also the credit quality of those that are holding the debt. So if it's held by those with great credit, it's less worrisome than if half that amount was held by people with very bad credit. So let's look at that. Mortgage originations by credit score. Here is just before the housing crash, 2008, 2009. These light blue lines up here are 760 plus, and the dark blue lines down here are less than 620. Fast forward all the way to today, the less than 620 and the almost less than 660 on down is almost non-existent. Look at the blue lines up here. This is 760 plus. So even though we have much higher mortgage debt levels on household balance sheets than we did 15 years ago or 14 years ago, it is held by higher quality borrowers. That's a big difference between now and then. Let's look at auto loans. You can see back here these little blue lines, not very big. Look at the size of them here. Is that there was been a migration up in credit quality of the borrower over time, which makes it a much more stable market. Let's go down to, I think we're going to go down to page 21 here. There's a lot of interesting charts here. I know I'm scanning past them, but if you're interested in some of this stuff, like third-party collections, this is number of consumers with new foreclosures and bankruptcies. Look at how it's drifting off, right? Foreclosures, look how low that is getting over here. Bankruptcies, look how low that's getting over here. Here's what we want. Select charts by age. Who is holding the debt? 18 to 29, 30 to 39, 18 to 29, very little, 18 to 39, 40 to 49 in here. These categories should get smaller as we get to 60 and 69, then over 70. So it gives you sort of who's holding it. We know it's high quality. This gives you sort of a breakdown by age, but what type of debt is each age group holding now? And this will tell you. So this just bases it on 100%. So you can look at the orange component. That's mortgage, and you could say, well, shouldn't the mortgage be decreasing later in life? Well, it does. The mortgage does decrease, but this is just based on of all the debt they have, the 100%. How much does the mortgage actually equal? This is not the total amount of debt they have by age. That's up here. You'd have to get that number from here, and I believe there is an Excel spreadsheet that you can download that is an accompaniment to this that has all of the raw data. Auto loans. Notice that it makes up a smaller percentage as you get older. This is the one I found interesting. Student loans. This is to be expected, and then it should drift off as a percentage of your total debt as you get older. But I get all the way here to 70 plus, and I find some student loans. And I think, how long is it going to take you to pay off your student loans? That's, I mean, over 70, and you still have student loans. It just, I don't know, seems odd, don't you think? But it gives you a breakdown of 18 to 29. What kind of debt are they facing? Student loans, mortgages, and auto loans. Auto loans to about 18 or 19%. Auto loan originations by age as well, 18 to 29 down here. You have the 30 to 39. I'm not going to go through all of the charts. Mortgage originations by age. A lot of interesting stuff in here. I've shown you what I wanted to show you. The big thing I wanted to show you was the credit, especially for housing, was the credit score by origination, mortgage originations, and the credit score, and how significantly different it is than 2006, 2007. And even when looking at the total debt, as we go through the charts, you see that the debt is held by, over the last 14 years, a higher credit quality borrower. Started showing these last week, so we'll continue with this. This is the option adjusted spread on high yield and on investment grade. 156 back in late 2018 hit 1.62, so it's still lower than it was on the last tightening cycle. For high yield, 538 basis points, so it is up on the week over last week, which ties it with the last tightening cycle at 538 basis points. Net yield in this index is 8.48%. This is just the spread. For ETFs that are tracking high yield, there has been net outflows, I think now for 3 or 4 weeks straight. There has been net outflows from these funds. Well, we had a little tour of consumer credit. Let's look at government debt. This is the federal debt, total public debt, $30.4 trillion. However, if you remove from the Fed's balance sheet, if you remove all of the government debt, just the government debt from the Fed balance sheet, you get to $24.7 trillion, not 30.4. You remove it because it's really just the government lending itself money, and it's the government paying itself interest. So you can net that out because all of that flows back to the Treasury when it's over anyways. As far as the level of debt goes, remember that as it was increasing its balance sheet along here, it was doing it at very low cost. So the 20-year and 30-year mortgages, the treasuries it was issuing during this period of time, were all low cost. So they'll continue for the Treasury to be low cost securities. So the higher interest rates are really only on new issuance. So every time there's a new issuance, it will have a higher interest rate component. But because rates are going up, it doesn't mean that rates are going up on $30.4 trillion worth of debt. Actually, you could just ignore the 30.4. It doesn't mean that rates are going up on 24.7 trillion. Only the new issuance will have those higher rates. A 10-year treasury that was issued 2 years ago at 130 basis points is going to be 130 basis points for the next 8 years. So that cost is not going to increase. Same with a 20-year treasury that was issued 2 years ago at 240 basis points is going to continue to be 240 basis points. It's only rolling over that is done at the higher cost. So if we think about dollar cost averaging, you can think about that the same way. That sure, rates are rising, but at some point rates are going to be lower. And when rates are starting to drop again, any debt that is being rolled over will be rolled over at lower and lower rates. If we look at total public debt as a percentage of gross domestic product, 124.7 seems rather troubling, but you can't use the 30.4. Let's use the 24.7 trillion. It's 101.43. This is less the Fed U.S. Treasury debt. 101.43 instead of 124.7. Still a lot higher than the 60% that we seem to think that it should be, or that at least it was from like 1990 to 2010, ran about 60% of GDP. I think we can all agree that even 100% is too high. We saw consumers' balance sheet running 80%, as opposed to 101% where the Fed is. We have to measure public debt in terms of public income, public revenue, which is the best proxy for that is GDP. So there are a number of ways out of this. You can increase taxes to pay down the debt. You can reduce spending to run surpluses to pay down the debt. Or you can increase the tax base. You increase the tax base by having more jobs at higher wages. So more people that are working, more people who are paying tax. If they're being paid higher wages, there's a higher tax base to tax them on. More people being taxed. Or higher growth. When we say more people being taxed, it's, hey, you're not paying any tax on this thing right now. Let's introduce a new tax on that. It's not that we're increasing taxes, it's just we're widening the amount of things you pay taxes on. This one here, from both sides of the aisle, in almost every country, seems to be ignored. This idea of reducing spending. We have typically you have action on the tax level and hope on the tax base. Is more left-leaning governments tend to want to increase taxes and say that growth will take care of the rest. That we can get the debt down, we can grow our way out of debt, but let's increase taxes, as a start. Whereas those who are more right-leaning tend to want to reduce taxes and say, well, let's grow our way out of debt. Both sides of the aisle think they can grow their way out of debt. Both sides of the aisle don't even think about reducing spending. The only way to tell them apart now is which direction they want taxes to go in. Now, all you have to do is tell me this group of people want taxes to go up. I'll say, well, they must be left of center. This group of people want taxes to go down. Well, they must be right of center, because you're going to get nothing here. This always seems to just be imaginary. We can grow our way out of it. The only way really for the U.S., given its demographic profile right now, the only way for the U.S. not to follow countries like Japan and where China is headed is immigration. Immigration has to be increased dramatically if it doesn't want to follow the path of Japan. And again, that's a hot button topic. I just don't see that happening. So what do you have left, right? More debt, either ever increasing debt. And if you do, there's going to be a limit to how far the central bank can raise rates before breaking the country, before breaking the Treasury, before the Treasury walks over to the Fed and says, listen, a word about your interest rates here. It's killing us. I think this level of debt over here has to at some point factor in to the decision that the Fed is making, because at some point it's going to become a problem unless governments start working on this right here, reducing spending, significantly reducing spending, and working on the tax base by allowing a higher level of immigration. So I think it's worth taking some time to look at the balance sheet of the Federal Reserve, where through 3 weeks of June, 35 billion of treasuries was to run off, 17.5 billion of mortgage-backed securities was expected to run off. And I did this because earlier this week there was a thing on Bloomberg showing how the Fed's balance sheet was actually increasing for the month, but it was showing the balance sheet. Well, you can't show the balance sheet. You have to show the securities portfolio, the securities held outright. So there's total assets, and then there's securities that are held outright. We have to pay attention to the securities that are held outright. I'll show you where to get all this in a second. And there's a drop-down menu that gives you a bunch of things that you can look at. This is selected assets of the Federal Reserve. At the very bottom, you see these two lines that are collapsed. It's because there is information in there. There's four lines on here, but these so dominate these two that these two collapse completely. If we look at the securities held outright and the value that they are, this is from May 18th onwards, the 22nd, the 25th, June 1st, June 8th, June 15th, and June 22nd. It doesn't look like it moved very much. We went from 8.483 to 8.494. And this is for securities held outright. Of this 8.494, 8.404 is what we have to pay attention to. So we're not going to get a lot of information out of here. Once you start with this, you say, well, it doesn't look like it went very far. Then you have to say, well, this encompasses the SOMA, and the SOMA is a subset of this, and any reduction is going to come out of the SOMA. So increases could have come from somewhere else, because you did have an increase of 1.64%. So I thought, well, could that partly be amortized interest over time? That if you're writing these at fair value and whatever the price in the market is, that fair value is going to have the amortized interest component on there. So I dug a little bit deeper to figure out how they account for things, and I found this. The primary difference between the accounting principles and practices in the Financial Accounting Manual and GAAP is the presentation of all system open market account securities, the SOMA securities, which is 8.4 trillion. At amortized cost rather than the fair value presentation required by GAAP. So it's amortized cost. So I'm not going to find the answer that I'm looking for out of that. I got to dig down one more layer and go into the actual holdings of the open market account. Okay, this is just for the open market account holdings. Here is the total, and here are all the components of it. This is June 1st, June 8th, June 15th, and June 22nd. If this was the balance on the 1st and this is the 22nd, we should see something going on, right? And these are in thousands, so when it says 326 million, that's really 326 billion, that's 4.9 trillion. This surprised me. Agency mortgage-backed securities, almost 3 trillion in total. So U.S. T-bills from the 1st to now, no change at all. Has the same balance in there. Treasury notes dropped $9.2 billion. So we had a drop of $9.2 billion versus 35 billion. So maybe between the 22nd and the end of the month, maybe that was just when the maturity schedule was. The rest of it runs off at the end of the month, but we're not quite there. Only 9.2 billion has dropped compared to the 35 billion it was supposed to drop by. All the rest are stable categories. Nothing dropped here. Agency mortgage-backed securities increased by 21.4 billion. The agency commercial mortgage-backed securities decreased by 24 million, which is almost nothing. It's a rounding error. So we have a curiosity here that this has increased by 21.4 billion versus what we would have expected is a $17.5 billion runoff. So that the SOMA holdings from the 1st of June to the 22nd of June have actually increased by 12 billion, and we were looking for negative $52.5 billion decrease. It's actually increased by 12 billion. We're off by 64 billion somewhere. So just to make sure that I got this number right, I looked into it a bit more. These are listed at current face value, and the face value is simply just the remaining principal balance that is left, the current face value. Not the market value, just the current face value, which makes me wonder how did it go up unless it bought more, not decreased. It went up by 21.4 billion. Anybody know why? I don't know. I'm not that familiar with the accounting policies that the Fed would use. Maybe there is an accounting reason why it did that. But just from first look, it looks like it went the wrong way and it should have gone down. It has federal agency securities here, in case you're wondering what they are. They're bonds issued by Freddie, Fannie, and the Federal Home Loan Bank. It holds some of those. It gives you change from prior week along the bottom. This is the only week in which the balance sheet shrunk, or the SOMA holdings shrunk, and then they increased by 10.8 billion and another 1.2 billion. Overall, $12 billion increase. So again, if anybody knows, can help me explain that number, and maybe I'm missing something over here. We'll look at this again next week on the 29th, and maybe things happen all at the end of the month. You know, maybe they had a plan, and during the course of the month, certain categories were going to increase, but they knew something was going to happen at the end of the month based on maturities or based on when payments arrive, and that everything was going to happen in that last week. So I'll reserve judgment until I see the whole month of June. But right now, I have a big question is, aren't we going the wrong way on this one? Let me show you where I got this from. Okay, this first one here is from Federal Reserve. The link is in the description box. If you click on recent balance sheet trends, you can see how messy this diagram can get as you move your mouse across it. It gives you total assets, securities held outright, support for specific institutions, and all liquidity facilities way at the very bottom. And you have a drop-down menu. You can click 1 year, year to date, 6 months, 3 months, but this bottom series pretty much disappears when you do that. So if you click all, at least you can see that there's something going on at the bottom of the series. And then you have different things that you can look for. So total assets. This is selected assets, total assets of the Federal Reserve. It just gives you one line. When you're looking at total assets, it doesn't break it down enough. You really want to know how much is securities held outright, and of those securities held outright, how much is in the SOMA. For that, we'll go over to the Federal Reserve Bank of New York, the System Open Market Account Holdings of Domestic Securities, and this is from June 22nd. If you just click on Previous, it gives you June 15th, there's June 8th, there's June 1st, it gives you May 25th, and you can keep going back as far as you like, or you can just export the current release. If you want to go into some more of the details, let's get back all the way to June. The latest one, you can break it down into T-bills. It gives you the maturity date of the T-bill, the par value, the total outstanding, the change from the prior week, so you can see exactly what increased or decreased. T-notes and T-bonds as well gives you the same thing. Agency debt, there's MBS over here. It tells you exactly which, what securities they're holding, right down to the security and the face value. If you want deep dives into exactly what they're holding, it's all right here at the Federal Reserve Bank of New York. The Bank of New York, the Federal Reserve Bank of New York, is where all the traders are that handle all of the purchases, all of the open market operations. The Fed sets policy, and the Reserve Bank of New York carries it out. Okay, during the last week, big pullback in copper. Copper prices have come off quite a bit. In fact, last week, most sector ETFs were up except mining and mining and extraction were down for the week, coming off elevated material prices. But there still is a lingering problem in the mining sector, is much as the U.S. housing sector, underinvestment for a long period of time has created shortages. These shortages aren't going to go away. We may have a recession which brings demand down, but it's not going to do anything to fix the supply problem that exists. And since we are moving super fast and headlong into an electrified world, copper can only go higher. At least, my thinking is. So let's just, I'm going to start including a little section on where we are in mining and minerals. Wall Street Journal had a story last week. Mining firms are cautious to spend on CapEx. And their conclusion here, spending threatens the shift to green energy, which when I did the video on the shift from ICE to EV, I did point that out, that the shift to EVs is going to hit a supply wall at some point because investment has not kept pace to grow at the same rate as the expectation everybody has at the speed of the shift over to EV. 10 largest companies, 40 billion in CapEx planned. The 10 largest companies in 2012 had 80 billion of CapEx. So that is half the amount. Freeport McMoran is going to have lower CapEx in 2023 than they have in 2022. So that is going in the wrong direction. The sum of CapEx for all firms equals about 100 billion average for the last decade. And Bank of America is saying that if you're going to hit the targets by 2030, that needed to be 160 billion, which means you need massive investment going forward. That the number of mines in the world, mining capacity, pretty much has to double over the next 10 to 15 years to meet all of the targets that not only governments have set, but individual companies have set as well. And, it's not just the move to EV. It's the move away from coal to renewable energy sources, to wind, to solar, all of that. If you electrify all of that, move from carbon to electrifying all of those things, you need copper. Now, you can use aluminum, but aluminum had some real problems with fires. I think aluminum was abandoned like 40, 50 years ago, and copper really is the de facto standard now. Headwinds to CapEx at this point in time. You got rising costs across the board, rising costs for fuel, for equipment, interest expense, because you're not getting this done with cash flow. The amount of CapEx you need, you're going to maintain some kind of debt to equity ratio. Some of that's going to be financed with debt. You got to go to the public markets for that. Plus, there is this trend, and I think rightfully so, but there is this trend that mining companies are going to have to get used to. Emerging markets are wanting a greater share of earnings, so that a project in an emerging market today versus 20 years ago has become less attractive because the emerging market wants a greater share of the profit that you have. So your cash flow is going to be much lower because you have to profit share with the emerging market. Combine that with a higher cost of capital, doesn't make the project look that attractive any longer. So I think you'll probably have emerging markets stepping up, being a financing partner to the company to start a project, and then being the financing partner assumes some of that cost of capital. Other sort of negatives in the EV space as well, lithium and cobalt. The steps to increase supply are not enough to fill the expected shortfalls. That is a conclusion from the article as well. Lithium, Serbia has revoked Rio Tinto's mine permits. Actually, they were exploration permits, but has revoked them. This was a $2 billion investment that they were going to make in a lithium mine. Environmental protests. So Serbia said, okay, people, we'll do what you say. Rio Tinto, you got to go. So that's done. Piedmont, North Carolina lithium project. This is a big one as well. Delayed. Regulatory review delays. They were to begin supplying Tesla with lithium somewhere between July 22 and July 23. That's when they figured they'd start. This is an open pit mine that they were going to develop. Now they have no definitive date for shipments to begin, and they've said, yeah, we're kind of looking outside of North Carolina now. We're looking at Canada and we're looking at Ghana because we have no time frame on when we can get this done. Somebody in the comments section had said that I didn't mention all the lithium projects that were already in the works. There are lithium projects in the works, but many of them aren't going to go anywhere. We can see this one in Serbia. You can take that one off the list. We could see Piedmont in North Carolina. You can take that off the list. You can look at Thacker Pass in northern Nevada. You could take that off the list. You can look at the ones in China, and you can downgrade those significantly because the yield is significantly lower out of those mines than at other mines. So you might need several orders of those mines just to equal one higher yielding mine. So even though there are some in the works, this is what they're going to face. You got environmental protests, you got regulatory review delays. This is common across the board. Nevada's going to be tough because you need water rights. That's a big holdup. So I do see this coming to a wall at some point. This is another brewing problem. These are storm clouds on the horizon. I wouldn't discount this and say, oh well, that's nothing. I think it is just a sign of something, and it could become something. The risk is there. China's electric vehicle battery supply chain shows signs of forced labor. This was on CNBC, and they're quoting the New York Times on this one. Chinese companies that produce raw materials for electric vehicle batteries show signs of using forced labor. Shenyang Non-Ferrous Metal Industry is a company that produces minerals and metals including lithium, nickel, and copper. It has exported metals to the US, Germany, UK, Japan, and India. This is from the story itself. The report was published on the eve of the Uyghur Forced Labor Prevention Act taking effect in the United States. The legislation bans goods made with forced labor in Xinjiang from entering the U.S. market. The Times reported that thousands of companies could have some link to Xinjiang in their supply chains. If fully enforced, many products, including some needed for electric vehicles, may be stopped at the border. So that is just going to be yet another issue in the supply channel for EV batteries. Whether this becomes another, 50 years ago, oil in the Middle East looked the other way on certain things just because we need the oil. Does it become this? Does it become let's just look the other way because we need the materials? It's not as if Western countries standing on the moral high ground haven't looked the other way if it was in their best interest to look the other way, and then moralize when they want to make a point about something. So I would say that this is a cloud on the horizon that I would at least keep my eye on. All right, here's a chart of copper prices. It's the HG futures price. Previous close 37465. It was as high as 4.8, 4.9 at some points. And this is going all the way back to the beginning of 2012 or mid 2012. The largest copper miners in the world in order: Codelco, BHP, Freeport, Glencore, and Southern Copper. I don't really like Glencore that much because it has a large amount of its revenue from coal. So it's just one of those things that I think are going to be a stranded asset sooner than later. So I'm I avoid. I'm not too big on Glencore. Average copper content. This is what I find really interesting. This is in pounds of copper. Over here, this is the story that I link with this is will give you the amounts in kilograms. Hybrid electric uses 85 pounds of copper. You go to a plug-in hybrid, you're up to 132, and when you get to a battery electric, you're up to 183. Now, I want you to think about that. Even if all the vehicles were hybrid, this is not plug-in hybrid, this is just straight hybrid, and you flip them all to battery electric, you're more than doubling the amount of copper you need just in automobiles. So think about going from ICE, which has even less copper than the hybrid electric, all the way to battery electric, and how many car companies are moving there with speed, with alacrity. They're converting all of their models as quickly as they possibly can. You're going to hit a wall on that too. I think that market's going to stay tight for quite some time. If you have a recession looming, I think you might have a small drop in copper prices, somewhere around the upper threes per pound, which is pretty much where we are right now. But I think that once you start looking past the recession, mid-2023 onwards, copper prices are going to accelerate. Some analysts see average copper prices hitting $6.80 per pound by 2025. I've never seen it at $6.80, even on the last cycle, the last super cycle, when copper was a king commodity, 2006, 2007. It didn't get to the levels of 480, 490 where it saw this year. To get to 680, think about that. That doesn't bode well for wiring prices. No, part of the reason is supply chain shortages, which might still linger for a couple of years, but also the increased demand from the EV sector, which is ramping up rapidly. You have an underinvestment from the mining companies, significant underinvestment, and you have basically the equivalent of an industrial revolution, this shift away from carbon into electrifying almost everything that exists, electrifying the grid, electrifying cars, electrifying buses, electrifying trucks, getting rid of coal-fired power plants, putting in windmills, solar. All of that requires huge amounts of copper because that's what electricity travels on. Electricity travels at half the speed of light in copper wiring. It is the best for electricity. I look at that and I think, well, this pullback in prices really had a large effect on the miners. There was a large pullback in that. And some of them have such big fat dividend yields right now that I think, you know what, I'm going to start picking away at some of these. So this ETF is a nice one. PIC. I'm going to start picking away at some of these. There's an ETF called PIC. It has 291 holdings in it. BHP being the largest with a weight of 14.39%, followed by Rio Tinto, Vale, Glencore, Anglo, and Freeport-McMoRan rounding out the top. 21, 31, that's about 40%, roughly about 40% of the ETF in these. And then I like some single names, BHP and Rio. So I'll show you what I've done with these three. Okay, this is the ETF PICK. Here is a 1-year chart. Here's its closing price, 36.62. You can see last week it was hitting 52-week lows. In this little insert over here, I have a 10-year chart, so you could just draw the price line back for the last 10 years on this one. So it seems to be hitting some sort of support level if we think that we have some support along here. I sold the August 36 puts 168, and I'm looking at 15 to 20% of what a full position would be. So if I felt that, you know what, this is good, I want to own it, what's a full position for me? And then you multiply it by 0.15 and you say, okay, I'm going to sell that many puts now and I'm going to get my first position, 1/6 or 1/5 of a full position, because I don't know where it's going to go from here. It could weaken over the next 2 to 3 quarters, but then I'm looking at it as a multi-year holding, a multi-year play, because I get paid to hold it. Number one, the dividend is about 358. The last 12 months dividend was 358, which is about 10%, and it has nice options. Which means I can manufacture a second dividend on top of that. So I can get a dividend on this of about 20% a year. So I'm going to start building my position now. If the August put is not put to me, I will just keep repeating. I'll do the same thing in September and October. I'll just keep selling puts until the initial position is put to me. If it is put to me, I will do another 10% of whatever position I want in puts, either for September, October, and I will also sell calls for September, October. This is called a short strangle. So let's say I sell 10 puts for 1,000 shares. And let's say that I want 10,000 shares of this. So I'll have 1,000 shares. If it is put to me at 1,000, my average price will be 36 minus 168. I'll then see where we are on the chart, and I will then sell some puts below for another 10%, which would probably be another 10 puts, and I will sell calls above on that as well, which is my short strangle. Now I have the underlying, and I do want the underlying in this respect because it does have a nice dividend. So I'll get that dividend on the underlying, plus I'll try to manufacture between the two of these another complete dividend as well, which means my calls will probably have deltas of around 0.16, and same with the puts, around 0.16, 16 on the deltas. So I am picking away at pick. This is BHP. This is we're looking at a 1-year chart. They finished here at 56.32. So if you draw a line across there, they have been lower over the last year. They're not at any 52-week lows, but it's this sell-off here that has me really interested, down from the 72s into the 56s. And I think this is in anticipation of a slowdown or a recession. Then yeah, all of these things will pull back. But the long-term fundamental story is still in play. Massive underinvestment in the space. So you're going to have tight spot markets for quite some time to come. August 55 puts, I sold these at 285, looking to fill 10 to 15% of my position. As a first step out the door, I just want to get my foot in there. I'm not looking to add half a position or a full position, just a small little amount to start, because I don't know where it's going yet. And I don't want to just commit to the whole thing and then have it visit 46 and revisit the 52-week low. I would rather get it on the way down. You're never going to pick a bottom. You're never going to pick a top. The best you can do is average your way into a position and average your way out of a position. These August puts is prior to the ex-dividend date. You do have to watch that sometimes, that a stock will go ex-dividend before your puts expire, which means that you should have the dividend in the put. The equivalent of whatever that dividend happens to be would be reflected in the value of the put. So you have to make sure you get paid for that, plus you get paid for the volatility of it as well. It doesn't have any dividend exposure at this point in time. I'm getting paid fully for time value, for volatility here. This is a 10-year chart of BHP. We can see that it's had significantly lower prices at that time. It has peaked above that in the last 10 years as well. But copper prices, which it is one of the largest, second largest copper producer in the world, I think, again, long term, with the requirements for copper for everything that the world wants to do, are double and triple of what it's doing right now. And this has a pretty big dividend too, dividend yield greater than 10% at this current price. So I'll take that dividend yield and I will use the options to manufacture another dividend on top of that. What is interesting here, the September 50s are 270. So the 55s for August were 285. If I then bring it another $5 down on the price, I could go out to September as well and do the 270s at the same time for another 10%, thereby having 20% of my position at $5 intervals. And if it does pull back, I can then hop out to October when October comes online, and I can look at the 45s and and sell the 45 puts, hopefully for the same premium. And finally, this is Rio Tinto. Dividend yield again greater than 10%. So I get paid to hold it. This is the 10-year chart down here showing where the current price is in relation to the last 10 years. August 60 put is 370. And again, just looking to step in, you're going to look to do 10 or 15% of what you think is a full position. And as with PIC, if it's not put to me, I will roll over my puts to the next month at whatever out of the money put would be. If it is put to me, then I'll do short straddles for the next month, which means I will look to sell calls and I will look to sell puts I'd want to replicate the entire dividend again using the premiums on the options. Typically that would give you deltas of around 0.16 on the upside and on the downside. We're sitting here at 63, which is almost a 52-week low, just under 60. And I've sold the August 60 put. If put to me, gives me an average price of $56.30. The dividend yield is over 10% based on the current price where it is now. So those are the three I'm looking at: Rio, BHP, and I've added PIC. I may in time add some miners for growth. And if you're adding miners for growth, you're adding junior miners. But it's way too early to begin to add the junior miners now. I'd say probably, if we have a slowdown, a significant slowdown into a recession coming up, once we start seeing signs that the recession looks like it's ending, or that it's clear that we're in a recession and the central bank is talking about pausing or even reversing its rate movement, then it would be time to start building positions in some juniors. Let's look at where we are on the SPY. We did have a big rally on Friday, which gave us a positive week, sitting at 16.6 times forward four quarter earnings, which is 235.68. Again, this is Q2 22 to Q1 23, the forward four quarters. S&P 500 finished at 39.11.74, so that's how I got 16.6. 17X is 400 on the SPY, would be 400.6. You have significant resistance at the 415 to 418 level. We're sitting at 389.63, call it 390 on the index. I'm looking at the September 415 call, 692, thinking of selling because I would sell this rally. I haven't sold any of them yet. I want to see what kind of follow through we get on Monday when the market opens. The resistance point 415 to 418, that's 25 points up from where we are. So if we do get a rally, I'll begin to sell 415 calls, and probably every 5 points up I'll sell more 415 calls if we get to 415. We do have earnings coming up, so earnings, well, could be a tailwind, could be pushing us up, or it could be a headwind. Especially if we see margin compression. That's the big thing that's going to be looked at. Have companies been able to raise their prices and manage their costs well enough to preserve their margins, or is there going to be margin compression? And it's not going to be this one or that one, but a general theme overall. So it's hard to know where we're going to go until we get earnings. The Fed meeting, again, as I said earlier, is all the way at July 27th. We have PCE, which is coming out Friday, next Friday. So you have Monday, Tuesday, Wednesday, Thursday in which to trade. Depends on what the narrative in the market is. If it is turning more dovish, if we think that we're at peak hawkishness and peak inflation and peak negativity, this rally could continue. I don't like to take full positions all at one time, although I'll tell you something, over the last couple of years that's always been a mistake, because the market has never given you time to take a full position. You step in, you take 20 or 25% of a position because you think something's going to go up, and it goes to your price target in 17 hours. It's was frustrating. But I think we have a different market now. I think there's a lot more caution, but I do think they'll be selling into this rally as it increases. I don't know so much that there was a lot of selling on Friday. It didn't feel like anyone was selling into the rally based on how we closed. So I am looking at selling 415 calls. If we get to 415, if we hit this number, at this point I would probably drop down to about 380 and then start selling calls at 380 because I'd want a very high delta on that one. Selling calls at 380 as the market is dropping, it's just, it's a proxy to shorting the underlying without having to actually short it. You got July Q2 earnings coming up sometime mid second week in July onwards. We do have some earnings this week coming out. Walgreens, Nike, General Mills, and Micron. I listed 4 that I think are important to look at. Health of the consumer. I think for discretionary products, Nike is something to look at. And here you're going to see the effect of the US dollar as well. Walgreens, this is retail. More staples, but they do have, I think they have more and more of their shelf space dedicated to giftware these days, so that'll be interesting to see. General Mills is considered defensive, but they've had some price increases in their commodity costs, especially their input costs. We'll see how they handle that. And Micron will give us at least some look at the chip space. And there's where we sit. It's kind of an odd place to be right now, is that, a lot of negative stuff is we already know the negative stuff. We already have it. We don't have any positive stuff, but we don't really have any big things happening for a while. Again, the Fed is all the way at the end of July, so what gets us over the next 4 weeks? Earnings, and I think it's going to be all about earnings. Okay, we'll end here with some auto news. Somebody had asked me what I plan to do with my GM position, or what I have done with it. It's a big position, unfortunately, and I had said a couple of weeks ago the biggest mistake I had made this year was in not selling it sooner. I just didn't think it could get much cheaper. It had great earnings. At $55, it rallied at 55, sold down to 50, sold down to 45. GM reaffirmed their guidance, and at 45 I thought, well, here we are, that's good. Went to 40, and then 35, then 34, then 33. The market always has something to teach you, right? Momentum teaches you that an expensive stock can get even more expensive, weakness in the markets teaches you that cheap stocks can get even cheaper. Just when you think something can't possibly get any cheaper, hold my beer, says the market. Let me show you a few things. Let's start at the bottom, 2 headlines here. Toyota cuts July global production plan by 50,000 vehicles. This is their second cut of 50,000 vehicles. The first time they said we still expect to maintain our full year guidance. Now they're saying that full year guidance is not going to happen. Semiconductor shortages and COVID-19 parts supply disruptions continue. This is from June 22nd from Reuters, so it's fairly recent. That's not going to do anything to increase the supply of autos on the market. I remember from CPI, the combination of new and used vehicles makes up about 8% of the CPI basket. Taking more vehicles off the market isn't going to help. And this is not going to be something that is simply unique to Toyota. That is a broader symptom. Everybody's catching this cold. World's largest truck maker says it's facing enormous supply chain pressure. This is Daimler Trucks. And it's not just microchips. They have, at this point in time, a 200,000 unit backlog in the US alone. So even if the supply constraints start cleaning up, they still got to work off that backlog. Well, this is, again, constrained supply. In the U.S., last auto sales showed that there's a run rate of about 12.4 million vehicles per year, down from 17.5 to 18 million vehicles. So in a recession, you would expect that to take a hit down to pretty much where the constrained supply is. So in essence, the U.S. Auto industry or auto market right now is running at recession levels. So I don't know that a recession will drop the number of delivered units even more when the number of delivered units are shrinking every week. You hear something like this, where a company is shutting down production here or shutting down production there for a week or 3 days or 2 days because of parts. Tesla will be shutting down Shanghai for a number of weeks beginning July, sometime to early August, and that is to increase the productive capacity of the plant. They plan to double the productive capacity, which, seems like a puzzling statement, that if you could double the productive capacity of a plant in a couple of weeks, why wouldn't you just have done it when you built the factory? It just seems to me that if it only took a couple of weeks, why would you do it? My other question is, really? It only takes a couple of weeks to double the productive capacity of a plant? Really? Anyways, there it is. I think hiding behind that statement is a parts shortage somewhere there as well. It just, hey, listen, if we got to shut down because of a parts shortage, let's do something we need to do anyways, which is increase our productive capacity. So I think that there's probably two headlines in that one headline there. This is interesting, and I think the second one here is, I'm not too concerned about this, but this one here, to me, seems like it should be getting a lot more attention than what it's getting, because this is a risk factor, I would seem to think, of operating inside of China. That if China wants a nice retaliation for Huawei, you're going to ban Huawei because you think the Chinese government is spying? Fine, we'll go tit for tat. China doesn't play a short game; they play a long game. Let's let this company invest billions of dollars in our country and set up, and then we'll retaliate for Huawei. But it's a storm cloud that I think we should be paying attention to. China is banning Tesla owners from driving near the government's summer retreat, another sign Beijing considers the vehicles U.S. spies because of the cameras. Berlin State Police banned Tesla Sentry Mode in city police complexes. An internal document leaked showing the reasons for the Berlin police decision. Tesla, quote, poses a security-related threat to employees, others, and Berlin police property. I'm not too concerned about this. It's like, oh, that's interesting. Did you hear about this? This to me seems like it could be a player on the chessboard. If the U.S. makes a move and says, listen, you have from Shenyang, you have some of this EV battery material being made with forced labor, we're going to put that on the list too. If the U.S. leans into Taiwan a little bit more than they are right now, if the supply channel hits a wall in the amount of supply, I can guarantee you China's not going to come down on Tesla's side on any of that stuff. They may even use Tesla as a good retaliatory measure that you're going to call us spies because of Huawei, we're going to call you spies because of Tesla. Now, we're not there, but this is a communist government that does not bring issues to the people for vote, and that are quite strategic in what they do. I would seem to think that there should be some risk factor priced in, especially if Tesla is, doubling the capacity at Shanghai and relying more on that for export. I'd be a little bit more concerned as an investor, saying, well, there is a definite risk factor in being there. This, I don't think, is something that I would look at and say, that's just, that's over concern. As soon as the party meeting is done in that city, everything will be back to normal. I think that, as tensions increase between China and the U.S., you got a company sitting right in the middle of that could take some fire over any of that. Anyways, just something to think about. I found it interesting that when I read the China headline, and then a couple of days later, June 23rd, I read this headline. I thought, wow, that's kind of interesting. I wonder if that's this on its own, I would say, This on its own, I say, well, I'd keep my eye on that. That to me seems like an issue. Especially if China wants to favor its own domestic producers. If Tesla vehicles get too popular and it wants to favor its own domestic producers, it's already raised a concern. It's already floated that concern and put it out there in the marketplace so that it doesn't have to manufacture anything later on. It's already manufactured something and put it out there. Anyways, let's have a look at the week that's coming up. Okay, Monday, right out of the gate, 8:30, you have durable goods orders. The second one here, durable goods ex transportation, that'll be the one to watch because vehicles have their own particular problem right now. You could get a drop in durable goods that are primarily due to a drop in vehicles, not because demand has dropped, only because the ability to deliver them has dropped, thereby making it appear that durable goods came in lower. So watch X transportation. This is for May, a little backwards looking. Pending home sales for the month of May, again a little bit backwards looking. What else do we have here? Retail inventories. If we think the consumer has slowed down, and this is backwards looking again, it's for the month of May, but if we think the consumer has slowed down, we would expect to see a build in inventories. That's going to be hard to tear apart with a supply channel improving. It could be that you're getting a build in inventories because the supply channel is improving. You could get a build in inventories because the consumer is slowing down. We have both a demand and a supply issue going on at the same time. So any movement in a data point, you got to stop and say, well, now hang on a second. Is that a supply side argument or a demand side argument? What else have we got that's important here? On Wednesday, you have your mortgage applications. Been up for 2 weeks in a row. Let's see what happens for the third week. GDP growth, it's your final look at GDP. This is the third look at this number for Q1. So not a lot of surprises here. It says it's a report with high importance, but the variability between the second look and the third look tends to be very low. So I don't know that much will change. I think it'll come in pretty much as we think it's going to come in. Next month, you get your first look at Q2 GDP. That is going to be a blockbuster. What else? Powell at 9 o'clock. What's he going to say? Right? Let's go into Thursday. And I had said that PCE was going to be Friday. It's actually Thursday. This is the big one. Core PCE. Forecast of 4.8. Anything higher than that, you can pretty much guarantee a sell-off. Anything lower than that, I think you could pretty much guarantee a rally. So I think 8:30 on Thursday morning is a pivot point in the market. Either we'll continue with if we continue with the rally into Thursday, and this comes in. If you print a 4.6 or a 4.5 on core, we're off to the races. I think that we can even move past that resistance line at 4150, 4160, maybe even move past that into the 4200s if we see it come down, because that would take the Fed off of the recession path. And then I would lower my forecast or my probability of recession from 100% down if that allows them to move 50 basis points at the next meeting instead of 75. A lot rests on this one. This is their preferred inflation measure, is the PCE, because it measures the cost of living. For Canada, you have GDP month over month. It's really backwards looking. This is all the way to April. You get GDP on a monthly basis in Canada. This is all the way to April. You have a preliminary for May. That'll be the more important number to look at. What else do we have in here? Personal spending and personal incomes. That'll be the income, I think, will be important. If incomes on an annualized basis can come in higher than the core PCE on an annualized basis, that's positive for real disposable income. And Canada closes for July 1st. And then we're going into a long weekend where the U.S. is closed on July 4th. I wonder if they got together and planned that. Hey, let's have a party on July 1st. And one country says, that's a lot of partying for one day. Why don't you do yours on the 1st and we'll do ours on the 4th? Because it seems like it's fairly close. Unless there's something about Julys where, hey, July's a great time for a revolution, you know. And for the U.S., 10 o'clock ISM manufacturing, PMI for June, and construction spending for May. That's it for next week. If I had to pick one and only one thing to wake up for, if I had to be knocked out for the whole week, it would be this one right here, Thursday at 8:30. This will also, I think, not only just have an effect on the market, but have an effect on the U.S. dollar. You print a 4.6 or a 4.5 or even a 4.4 on core, the U.S. dollar is going to reverse because there's a lot already built into the U.S. dollar. That U.S. dollar reverses, some of these other currencies go up. Oh, I should also mention, I have started opening a new position in the Aussie dollar, long the Aussie dollar as well. So I do have a long position in the Canadian against the U.S., and I've just started opening my first step in. Well, like I say, I like to build positions. My first step into the Aussie dollar against the U.S. dollar, and that is a long-term holding. I use futures for these. I don't use the spot because with the spot you have the interest rates on either side. So if you end up with a short position on a currency, you have to pay an interest rate on that short position, whereas with the futures, it takes into consideration both interest rates right away, and it's all built into the futures price. So there we are. There is next week. This is the big boy.